first intuition and to our series of revision sessions for Business Tax Finance Act 2024. My name is Anne. So I'm going to be taking you through the first intuition mock number 1, task by task. This is the second in our series, which deals with task number 2 on capital allowances. So without further ado, we'll get into task number 2. There we go. So if you haven't seen any of our previous revision sessions or you are new to FI materials, then let me just tell you that each task starts with a task briefing. Firstly, we're going to tell you what the task is about, and for task number 2, it's going to be capital allowances, 12 marks worth in the exam, so 18 minutes to get this task completed. We then have this task briefing, which is really useful as revision. So if you feel a little bit weak on the area of capital allowances, you may want to pause the lecture and have a read through that task briefing first. It is really just a set of revision notes, a condensed version of what we need to know for the capital allowances section, identifying particularly some of the differences between sole traders and partnerships, which are treated in the same way, and then limited companies where we can expect to see some differences. So there's all sorts of fiddly little bits going on within capital allowances. So that task briefing could be very, very useful for you. And of course, the other thing that would be very helpful in the live assessment is going to be the reference material. So this is the reference material in relation to capital allowances, and you can see that it's split into 2 distinct sections: assets other than cars, and then cars. So cars have their own section. So this is all the assets that are not cars up here, and then cars in the second section. So don't muddle up those 2 sections, they are quite different. But that's all we're told. So we're given the rates, but a lot of the other fiddly detail in the task briefing we would need to remember in the assessment. So we're going to go through a task, and as we go through the task we'll pick up on all the necessary bits in order to answer this particular task. Of course, we can't test everything in every single task, so it will be up to you to read through that briefing and make sure that you are familiar with some of the other little sections that could come up in other tasks, and make sure that you practice some other task 2s once we've done this one. So here's our task 2. Ferguson Limited. Okay, first thing, going to stop there. Ferguson Limited. This is a incorporated business. That's important because it has different rules on capital allowances to sole traders and partnerships. So I'm dealing with a company. It has the following non-current asset information for the 8-month period. Oh my goodness, another complexity. It's less than 12 months. It is an 8-month period, so only 8/12ths of a year, and the year ends July 2024. I've got some balances brought forward on the 1st of December of 2023. So as I now start to read the question, I start to think about the columns that I might need in my capital allowance computation. So I've got the general pool. I'm going to need a column for that. Special rate pool. I'm going to need a column for that. I have got some additions in the period. Some second-hand plant and machinery. A second-hand delivery van. Now I'm thinking here about a company, so I'm thinking about the area of full expensing. Just find it here. Full expensing is available on expenditure by companies as long as the expenditure is after 1st of April 2023. It is an alternative to the AIA, and there is no expenditure cap. So full expensing, there is no upper limit, so we can spend as much as we want. It's not available on cars because cars have their own rules, as we can see down there. And it is only available on new assets, so nothing second hand. So full expensing goes into its own column. We'd need to keep details of each individual asset that was included in there, because when eventually we sell the asset, we need to have a balancing charge. So with full expensing on disposal, we would create a balancing charge, because if we give a full 100% allowance when we buy the item, it sits in our pool at zero value, so when we sell it, a balancing charge will be created. So that's just a little bit of revision. Now I understand a little bit about full expenses as an alternative to AIA. I can decide whether it's appropriate here. So there's no upper limit. So if I'm spending more than £1 million, then I might choose to put some assets in the full expensing category. Can't be a car though, has to be new assets, and I have to be aware that there'll be a balancing charge when eventually I dispose of the asset. So let's see what we've got. Any of these qualify for full expensing. I've got second-hand plant and machinery. Okay, so it's second-hand, so that's not going to work. So that is going to have an AIA. I've got second-hand van. Interesting. Another second-hand item, so no full expensing. That one will also get an AIA. So vans fall into the plant and machinery category. It's only cars that fall into the cars category. And this is a new car for the sales manager, but cars don't get full expensing. It tells me about the emissions. It tells me that there is 25% private use. Now this is a company, so there's private use by the manager, but the company itself can't use the car, so we actually ignore private use for companies. So that is not applicable in company tax. The company cannot use the car, so there's no private use by the company, and the tax computation is for the company, so I ignore the private use. I am interested in the emissions, because when I look at my capital allowances here, it shows me the different emissions for different cars. So this car then, with emissions of up to 50 grams per kilometre, is what we'd call medium emissions. This is our high emissions, with a very poor 6% allowance. Got our electric car up here with 0 emissions, so no emissions. That's the electric car. We'd get 100% allowance on those because HMRC want to encourage us to buy electric cars. And then our medium emissions, anything over 0 up to 50 will get 18%. So just a regular writing down allowance. So let's just double check where we are. We're at 30 grams per kilometre, so we're looking at 18% writing down allowance on that car with no private use. So as I read through the question, notice what I've been doing there. I was thinking about the columns that I'd need. A general pool, a special rate pool, an AIA column now. I don't need a separate column for the car because it just gets an 18% allowance. There's no private use because it's a company, so it can just get lumped in with everything else in the general pool. I've got to also think about the fact that AIA is a maximum of £1 million. And that assumes a whole year. It's an annual investment allowance. This is an 8-month period. So I've got to think about that as well. The maximum here is going to be restricted to 8/12 of a million. I can only have an 8-month AIA because I've only got an 8-month period. As I read on, and this is still all about just thinking what the question is telling me, due to trading difficulties, the company ceased to trade on the 29th of February 2025. So I'm looking again for anything that is triggered in my mind when it says the company ceases to trade. And the first thing I think there is, oh, this is the final trading period, so there's no capital allowances. In the final period, we don't have any regular capital allowances as such, except our balancing allowances, our one-off final balancing adjustments, balancing allowances or charges. So there's no AIA, no WDA, no FYA, none of those. Simply a balancing allowance or a balancing charge on every single column, because I have to zero out every column in my computation because I have finished trading. So that is almost like a second computation. It's for a separate period. So I've got two computations here. My first one is an 8-month period with all these complications, and the second one is the cessation. Now I'm not even going to worry about the cessation yet. I'm going to park that in my mind and think that comes later. I can't do that till I've done the first one. So let me focus on doing the first one for the 8-month period. So we have this task as a human marked task in the assessment. Often in the actual assessment, it's going to be slightly nicer than this because they might fill in the column headings for us. They haven't bothered here, but we know the columns because we've talked about them. We're going to have an AIA. I'd always have the AIA, the full expensing, the FYA, etc. as my first columns. I'd always have my allowances as the very last column. And then everything else can fit in the middle. Doesn't matter what order the other things come. So the other things that had balances on were a general pool and a special rate pool. So we can pop those in. So we have our column headings. And then we have our computation for the year ended. Oh, it's not a year, is it? It's period. For our period ended. Just make sure I separate it out for the examiner. Period ended 31st of July of 2024. And we've got our balance brought forward, which was on the 1st of December of 2023. That's our tax written down value brought forward. So you can express it like that, tax written down value, or if you forget that, you can just say balance brought forward. Doesn't really matter. Then let's find the values that were brought forward. Here they are. Let's pop those in. So the general pool. There should be nothing brought forward in the AIA column because it has to be emptied out at the end of each period. So that will always be 0. So we then follow a very set pro forma for any capital allowance computation, where the first thing that we might do once we've done our opening balances is our additions. What did we buy in this period? So here we bought plant and machinery, a van and a car. That's what I'm going to list, 3 things. So plant and machinery, van and car. The plant and machinery should qualify for AIA. It's not a car. The van qualifies for AIA, but the car doesn't. Cars have their own section in the reference material, and they will either get an FYA if they're electric, 100% allowance. They'll get thrown into the general pool with everything else if they're between 0 and 50 grams per kilometre in emissions, and if they're over 50 grams then they're going to go into the special rate pool. So this one is going to go into the general pool because it's going to get an 18% allowance. So I'll put those in there. There's no disposals in this period. If there were, I might be thinking about those next. So let's add up the balance in this AIA column. Add up what we have in the general pool. And of course the special rate pool as well. So I'd do additions and I'd do disposals. There were no disposals, so just the additions in this one. Then I'd start claiming my allowances. And in the allowances section, it may be that you have an AIA, an FYA, we've got the special rate pool, we've got the general pool, lots going on. So the AIA is at 100%. It is a maximum of 1 million times 8 months. Now I'm actually not going to even need it because my expenditure is well below that, but I just want to make a note so I remember to check this myself next time, and also just so the examiner is aware that I remembered that rule. Are you going to lose marks if you don't include that? I'd say no, because you'd still get the right AIA anyway, but I'm going to include it in my answer here for you, hoping that you won't forget it when you see it again. So it's a maximum of 666,667. In this case, we only want 188,500 anyway. So my AIA is transferred into the allowances column. The general pool gets a normal writing down allowance, which is 18%. But because it's a short period, we can't have a full year's worth. So I calculate what 18% on that general pool would be. And then I say, oh, but you can't have all that. It's only 8 months period. So I times by 8 and divide by 12. That will give me a reduced allowance, which I will again transfer into the allowances column. So as I go along, every allowance just gets transferred into that allowances column. The same idea with the special rate pool, except that one only gets a 6% allowance. It's for high emission cars. We're not given as much credit for buying things with high emissions because it's not what we're supposed to be doing these days. So we get less tax incentives, although we still get something. So that also goes into my allowances column. So then that is the end of that first computation. I just need to balance it off. So I'd have my tax written down value carried forward. Or you can just put balance carried forward if you don't remember that. Nothing should ever be left in the AIA column. It's fine that the general pool has a balance in it. We just carry that forward into the next period. It's fine that the special rate pool has a balance in it. Any sort of pool or a column for a single use asset, a private use asset for sole traders and partnerships will also have a balance on. Don't have an issue with that. I just don't have a balance on AIA. And the total allowances for this period would be then what it would be included in my final capital allowances computation, my final adjusted profits computation. It's going to be this figure here. $233,603. So that would go into my adjusted profits working. So remember, in task 1, you're going to be tested on adjusted profits. One of the adjustments will be deduct capital allowances. Well, there you go. That's where the figure comes from. So our next period, also a short period, is going to now be the period ended 29th of February 2025. This is the period of cessation. And I'm going to start with the balance that was carried forward at the end of the last period, and that becomes the balance that is brought forward into this period. So only the pools have balances brought forward. The AIA column should always be emptied out. What I then do is I deal with the disposal proceeds. So I have to look at what's being disposed of. And when I'm doing the disposal, I've always got to include the disposal at the lower of the cost and the proceeds. Very rarely do we sell things in excess of their cost, but it's certainly something to look out for. You can imagine if you buy a machine or a lorry, you use it for 5 years, you don't expect to sell it for more than you bought it for. It'd be lovely if you did, but these machines get sometimes quite a lot of use, so they go down in value rather than up. But it can work the other way around, especially in exam world. So let's have a look. Proceeds, all lower than cost. Great, so they've confirmed that for me. So now I just want to take the proceeds from here. So general pool, great, that's going to go in the general pool column. Special rate pool, fantastic, that's got its own column. Delivery van, oh, well that doesn't have its own column, does it? That gets lumped in with the general pool. And then the sales manager's car also doesn't have its own column, so also gets lumped in with the general pool. So all of those are just general pool items. The special rate pool is the only one that's going to be separated. So let's add together those three. General pool plus van plus the car. And the total for the general pool disposals becomes 332,500. So that's what I'm going to include as my disposal. And for the special rate pool, the 70. So interesting there, when I do my subtotals, that I get a minus figure on one column and a positive number on the other column. So my first period there, you can see what's happened. The disposal proceeds exceed the tax value. So just a little note for you here. The proceeds exceed the tax written down value, which effectively means you have made a profit on sale. You have sold the items for more than the tax office thought they were worth. Profits are taxable. So instead of getting an allowance here, we are going to finish this one off with a balancing charge, where HMRC recoup some of the allowances that they have given you previously. And a balancing charge is like a minus allowance. So they're saying, oh, you've made some more money. So we would like to have our share of that back. So we put a balancing charge in there, and it becomes a minus allowance in our final column. So the column balances out to 0, as it should, because this is a cessation. Contrast that with the special rate pool. And in the special rate pool, number 1, in this one, the proceeds are less than the cost, or less than the value. Proceeds are less than the tax value. So we sold it for less than it was worth. That's like a loss on sale, which means that HMRC are feeling sorry for us because we've sold this asset at less than it appeared to be worth, suggesting they haven't given us enough allowances yet. Because we've got rid of it for 70, as far as they're concerned, it was worth 75. So there's 5417 of allowances that we haven't had yet. So they are a normal balancing allowance. Take them out of the column there to bring the column down to 0 and transfer them into the allowances column. And then we finish off with our total allowances, which in this case are a minus. So when we put those into our adjusted profits working, ordinarily we deduct capital allowances, but in this case they'd need to actually be added back because they are like a minus allowance. So they would go through to the adjusted profits working that we see in task number 1 of the assessment. So that's a great capital allowances question. I think it's very, very helpful that it deals with a disposal at the end of a business as trade. It's helpful that it deals with a limited company, so we can be reminded that there's no such thing as a private use adjustment. I think you should practice other questions which do have private use adjustments in, where there are sole trader or partnership style questions. This one was also good in that it had a short period, so we could be reminded to time apportion our allowances and so on. So we practiced a lot within this one, but there's a lot still to think about. So do make sure you dig out some other task 2s and give them a go. Then you can join me for the next session or subsequent sessions where we're going to go through some of the other tasks from the FI Mock 1.